coming into this year, we were, I'll call it, less bullish on the broad market than we had been in some time. The market was entering its fifth year of a bull market, which really started in 2008 to early 2009. And the market's been up a lot over the last 5 years. We thought this would be, coming off of a very strong 2013, tougher year for the broad market, given the fact that in 2013 the S&P was up over 30%, with really very little pullback and very little consolidation or correction. We thought it would actually be normal or necessary to see a more flatline market, a more difficult stock picking type environment. That's clearly the way that things have played out. This year really started out much like 2013 ended. Very strong first half of the year, very little volatility, light volumes. And as the year played out from really July on, we've seen a real change. There have been a couple of severe corrections, including a near 10% correction in October of this year. And stock selection has mattered a lot more than just owning the market. The S&P is up about 8-9%. Our portfolios have clearly performed well due to a few factors. The fact that we own companies which can grow in this environment. We've also had a number of companies involved in M&A activity or merger and acquisition activity, consolidation, with 3 takeovers across our strategy in the healthcare space and media space. So owning the right companies at this stage in the cycle, I think, is really the most important thing. And again, as opposed to 5 years ago when the entire market was cheap, today there are parts of the market that are cheap, and our job is to find those parts and those companies that can continue to execute in this environment. It's really been the healthcare area, which has seen companies grow through pricing power, new addressable markets, companies like Biogen and Vertex that have had what I'll call game-changing breakthroughs in science and new product introductions, as well as some real pipeline successes. We've seen growth in some of our technology names and good consolidation in the media space as well. I think those areas should continue to work. The real scarcity today is growth, finding growth in an environment where global growth is clearly below capacity. We're talking about 1 to 2% at best global growth today, and our job as growth managers is to find companies that can grow well in excess of that. We're clearly focused on certain sectors of the market, healthcare, parts of the media space, parts of the technology space, and we've actually increased our weighting in energy recently, given the sell-off in the market. So my outlook would be really more of the same. What you've seen in the very near term is really it's short-term dynamics. So you've clearly seen a very sharp dislocation in certain parts of the energy space. The pullback in the price of the commodities is virtually unprecedented. There was a very sharp pullback in 2008, 2009, but that was very highly correlated with the credit crisis. Today, with what you've really seen is again about a $45 to $50 pullback in the price of oil, with, I would say, not a corresponding change in fundamentals. So there are a lot of cross currents. You've had a very strong dollar. You've had clearly some new entrants into the production side of the market, like Libya, and an increase in production in the U.S. You've also seen a slowdown in demand from areas like China, which had really been the driving force for global growth. Having said all that, valuations of the companies that we own are at historically very low levels. And again, we're focused on quality balance sheets. We're focused on companies which can self-finance, so they live within their cash flows. And a company like Anadarko is a great example of that. And that's been a position that we've owned for 11 years. I think the positive offshoot of the pullback in equity prices, as I said, is you could see a big uptick in consolidation. I mean, there's been big stress in the credit markets as it pertains to the energy side of the business. Companies which are starved for cash could very likely be more apt to be acquired in this environment. And you can also see some of the bigger, what I'd call more liquid names in the major oil space looking to buy good quality assets on the cheap. So for us, it's really steady as she goes in terms of the companies that we own, looking to add to some of the positions that we've owned for a long time, given the sharp pullback in prices really across the board. There's been very little discrepancy in terms of which companies have outperformed or underperformed. Everything's sold off 40 to 50%. And as long-term business owners, we have the opportunity to pick up some very good assets on the cheap in this environment. So I do think the energy space, in terms of commodity prices, tends to be self-correcting, meaning a pullback in prices tends to lead to an increase in demand. And I believe, as I said, that longer term, if you have cash and you can take advantage of the dislocations currently in the market, there's probably bigger money to be made today than I would have said 12 or 18 months ago. So we have a portion of the portfolio in energy, and we're actually increasing some of our key weightings there, both on the exploration side and the service side of the business. If I had to describe my feelings on the market itself, the S&P is pretty fairly valued. The S&P at current earnings is about 18.5, 19 times earnings. On a forward basis, it's a little bit cheaper at about 17 times earnings. Without getting too technical, that's about fair. That's about where historically it has traded. Within that environment, I think for us, the goal is to find companies that can execute and can really use their balance sheets, both in terms of making acquisitions, buying back stock, returning cash to shareholders, in the case of dividends, which we've seen more of our companies doing. The big risk is to me, it's owning the wrong companies. And I think that, again, our job is to be long-term business owners, find companies that can live within their cash flows, companies which can use their balance sheets in accretive manners in today's environment of 2.5% interest rates. And I think we really own the right businesses. So the risk would be that the companies don't execute. The risk would be that companies can't meet their earnings expectations. But I think that a lot of the trends that have helped us this year in healthcare, in media, and technology is companies which have been able to really grow through innovation through this difficult economic period. And I expect that to continue. So I like what we own. There are parts of the market that might be overvalued, or even parts of the market that might be, I'll call it frothy on a valuation basis, but we're stock pickers. We have very high active share, which means there's a lot of the market we don't own. And I think that what we try to do in this portfolio is just find companies that can execute. And there's real opportunity, I think, still in this environment for companies that can do that.